Good morning, good afternoon, good evening. Welcome to USSEC Soy Stocks and Planted Acre Report webinar. Thank you for taking time to join us. My name is Jim Sutter and I serve as the CEO of the U.S. Soybean Export Council. And we are really pleased to be able to be your host today and have so many of you joining us from around the world. As you all know, today the U.S. Department of Agriculture released its U.S. Stocks and Planted Acreage Report for June 2022. And that's what we're going to be diving into shortly. And we know that this is something that everybody has been watching. And so we're very fortunate to have some experts to be able to talk to you about that today. As we wrap up the month of June, our farmers here in the U.S. have essentially completed their planting with great expectations for a great 2022 crop. And as this report indicates, we expect a large U.S. soy crop. And there's, uncertainty with exactly how many acres, but we'll get into talking about that. The world is watching this carefully because global supplies are tight, and we know that. And we encourage you, now is the time to look carefully and critically at the global environment and what your customers expect, what you expect for you and your business. These are very interesting times. Russia's war on Ukraine, the kind of aftermath of the COVID situation that seems to be winding down around the world, spiking inflation, supply chain disruptions, all of these things remind us of our shared responsibility to work together. And while this is happening, our U.S. soy farmers are focused on maximizing production of nutritious and sustainable U.S. soy so that our customers and their customers, families, people around the world can reliably access nutritious, safe, and affordable food every day. Whether you're feeding chickens, pigs, fish, or people somewhere around the world, reliable U.S. soy delivers improved digestibility, improved nutrient profile, and a great sustainability track record. Carbon footprint matters in many markets, and U.S. soy has the lowest carbon footprint compared with soy of the other major origins, according to the Blanc Consultants and the GFLI. Since 1982, U.S. forest land has actually increased 2.1 million hectares, while our cropland has decreased about 20 million hectares. So we have that moving in an interesting direction. Since 1980, our U.S. soy farmers have improved their greenhouse gas emissions by 43% per bushel, while increasing production 130%. So very impressive statistics. These things positively impact U.S. soy's ability to deliver on have a sustainable impact for our customers around the world, which we know is important. And at this time, it may be losing a little bit of focus, giving prices and giving shortages, but we know it continues to be very important. That's why we keep talking about it. Anyway, you're not here necessarily to talk only about that today. So let's review the program that we're going to have for you. In just a moment, I'm going to turn the floor over to Mac Marshall, who serves as the Vice President of Market Intelligence for USSEC and the United Soybean Board. And he's going to share highlights for the report. Then Mac will be joined by the President of the Pro Exporter Network, Mr. Marty Royka, who will also be joining us in person during the Soy Connects coming up, the Global U.S. Soy Summit that will be coming up in August out in San Diego. Marty and Mac are going to explore their findings from the report and discuss what it all means for the global soy complex and your business. We're then going to have a special spotlight on USSEC's Americas region by our regional director, Carlos Salinas. He'll talk about how things are going in that part of the world and the impact of today's report and the situation we have. Afterward, we're going to open it up live for questions and answers from all of you. And this is where you all come in. Please continue to put your questions throughout. Don't wait for later. But if you have questions now, or if something you hear triggers a question, please put it into the chat function and we'll answer it during the Q&A session. Again, thank you all for being here. And I look forward to the insights and the perspectives that our experts are going to share with us tonight. So at this point in time, I'm going to turn the floor over to Mac. Go ahead, Mac. Thank you.
Thank you very much, Jim. There's a lot to cover from today's report, so I am going to keep my comments pretty brief because we really want to get to the meat of the discussion with Pro Exporters Marty Royka and, of course, the regional spotlight on the Americas with our regional director, Carlos Salinas. So if we rewind to the end of March, USDA had initially pegged 2022 soybean planted area in the U.S. of a record 91 million acres. With today's report, that figure is revised down significantly to 88.3 million acres, which is still the highest U.S. soybean area figure since 2018. If we assume a trend yield of 51.5 bushels per acre, which is the trend yield that USDA is using in its balance sheets at the moment, the reduction in planted area implies a drop in projected production of about 130 million bushels. However, the implied crop size would still be a record 4.5 billion bushels if we assume that yield figure. The trade consensus was looking for a reduction from the March plantings report, but not of this magnitude. As you can see in the chart on the left, the 88.3 million acres from today's report was just below the low end of trade expectations. Now, while corn area was revised up by 400,000 acres from March to come in at 89.9 million acres, combined corn and soy area is just over 178 million acres, a 2.4 million acre drop from last season. The biggest change in soy area was in North Dakota, which saw the March figure revised down by 1.1 million acres, bringing it to 5.9 million acres, down from the 7.25 million acres planted last year. If we look across the major row crops of corn, soy, wheat, cotton, sorghum, barley, oats, and rice, total planted area is projected to be 251.9 million acres, down 1.6 million acres from 2021. When we're looking at the plantings report at the end of March, the expectation was for area to be just over 254 million acres across those 8 crops, and that would have been the largest area since 2014. However, with a late start to planting in many parts of the country, most acutely in North Dakota, that figure for total acreage has come down. On that, I think I'd be remiss if I didn't point out that USDA is also looking to resurvey some of the northern states, specifically North Dakota, South Dakota, and Minnesota, given the late start to planting. So those revisions will be reflected in the August 12th crop production report. So on the previous slide, we showed that the corn area figure was within market expectations. The same is true for wheat at just over 47 million acres. Area for cotton, sorghum, and barley was revised up relative to the March report. Both cotton and barley are showing double-digit percentage increases in planted area relative to 2021. Turning to the quarterly grain stocks report, June 1st soybean inventories were estimated at 971 million bushels, which was within trade expectations and a 26% increase from June 1st, 2021. Now, the June 1st inventory levels imply March through May quarterly disappearance of 960 million bushels. This would be the largest pace of demand during that particular quarter on record, with December through February disappearance clocking in at just over 1.2 billion bushels. Total demand for U.S. soybeans over the last 6 months has been quite robust as crushing remains strong and we are seeing counter-seasonal strength in our export campaign. So this concludes my brief remarks on the report. It is my esteemed pleasure to welcome to the program Marty Royka, President of Pro Exporter.
Thank you, Mac. In a moment, you'll see some slides that we're going to be discussing. The first thing I'll look at is how things came out versus last year. So this bubble chart is showing in clear bubbles the states where we lost acres compared to last year, and the shaded bubbles are where we increased acres. So most of the Corn Belt had some increases in soybean acres. The big problem, like Mac mentioned, is in North Dakota and Minnesota. And South Dakota, compared to last year, shows a 50 million or a 50,000 acre increase. But the problem is that that's quite a bit below still what the March intentions were. So, we thought we would get a lot more in South Dakota. So this chart's a little bit deceiving in that regard. I want to point out now in 3 of the last 4 years, North Dakota has had this condition that we call prevented plant. We won't know the official prevented plant numbers for soybeans for another couple weeks, but there's obviously something going on in our northern Great Plains where we're having wet spring conditions, which makes it difficult to get the crop planted. Next slide. In this slide, this is just a simple bar chart to show you how big the soy area is in the U.S. You can see that our record back in 17, followed closely by 18, was right at 90 million acres. Again, like Mac mentioned, this year we thought in the March intentions report that we would set a new record for soy, getting to maybe 91 million acres. And right now, the number's actually at 88.3. Next. So one more. Okay, so now I want to show you what this year's planted acres look like versus our record year of 17-18. You can see there's a really big difference in Minnesota and North Dakota. And the other really big difference is in Arkansas. We don't talk so much about what we call in the US the boot heel area. It's the area along the Mississippi River south of St. Louis. And it's very good soybean production ground. It usually plants early, harvests early. They get to sell their fall harvest into the fourth quarter of the marketing year, which is great for the export markets. This year, that crop was planted a little bit late. I wanted to show you this slide to show you, what it would take to get back to a record year, like we had in 17-18 with respect to acreage. And we know with the resurvey that the planted acres are likely to go up. And part of that reason is, even though we're past a prevented plant date, I think some farmers are willing to take the risk of still planting. Prevented plant date, all that does in the US is limit the amount of insurance. As each day goes forward past the prevented plant date, the amount of your crop that you can insure goes down a little bit. And it's kind of an incremental change. So at the very high prices we have for soybeans right now, we think farmers are going to have an interest in planting past the prevented plant date. Again, we won't know how much acreage that is until we get the resurvey report in August. Next. And so this is the total US row crop and hay pasture land total. You can see that we started at about 360 million acres at the beginning of this millennium. We're down to about 338.9 right now. And in the second to the last column on the right there that's shaded, you can see the prevented plant acres. Back in 1920, the total US prevented plant was 18 million acres, which is a giant number. The year after that, we had 8.9 million, and that still is a very, very large number. This year, I don't know what that number is going to be, but I think it's going to be above 1 or 2 million for sure. So that's just, something I want you to keep in mind. And next, I think we have one more slide. So in the supply demand table, you can see that for current crop year, second from the right, the 21-22 column, we're at the end of the marketing year. We're now showing a 205 million bushel carryout, which is a pretty small carryout historically. It's less than last year's. It's part of the reason for the high prices. If we have the crop that we think, so if we get this 51.5 bushel yield on the current acreage, and we have an export program new crop for 22-23 of 2.2 billion bushels, our carryout will drop to 150 million bushels. This is a very low carryout. And it's probably supportive of the price environment that we have right now. You can see that our crush is starting to go up. The really big years for crush increase will be 2 and 3 years from now, but we are going to see some increase in crush next year. And for now, I'm going to conclude my opening remarks with that. Thank you, Mac.
No, thank you very much, Marty. I think the historical perspective that you'd provided there is really valuable. And I think particularly looking back at the recent years we've had large prevent planting, particularly in the Dakotas, Corn Belt as well, from 2019. And you know, anytime we're kind of considering the existing market conditions, we kind of look for analog years. We could, as you said, see an uptick in prevent plantings due to the wet spring and everything. We, of course, had a very wet spring in 2019. But, as you had pointed out on the inventory levels we have, the projected carryout, we're in a very, very different position today than we were in 2019. In 2019, a couple million acres of soybeans not going into the ground. We had the, inventory levels that could, kind of cushion against that. Where we are now is not in that position. So, what's your read on kind of the balance of where we'll be as this crop progresses? I mean, are we looking at a pretty volatile weather market? What do you think?
Well, given that we're starting with a low carryout and we have projections for a low carryout, in my view, that makes the growing season, the way the weather gets traded, more risky. It's everybody wants to be pleasantly surprised and have a bumper crop, but our initial conditions right now are a little bit dry. It's not problematic at this moment, but it's concerning. And given how tight carryouts are, I think everybody's going to be on a knife's edge for the whole growing season and the harvest season. We need good harvest conditions as well. So we'll be probably in a weather market for all the way through the end of harvest in November.
I think I agree with you there because, just the last couple of weeks as we started to get those crop conditions reports in, and the crop, I think as of this Monday, was 65% good to excellent rating, ahead of last year, where I think we were at 60 at this point of the year. But that was a 3 percentage point decline from the prior week, and you saw the markets respond, I think, pretty notably. So, when those reports come out on Monday afternoons, we've certainly seen, some volatility roll in. But one thing I want to call out here, because we've got the nearby contract for July, which of course has been trading in the $16 to $17 range, and then we have the deferred new crop contract, in the mid 14s right now. So pretty wide inversion between spot markets and the deferred contract for when this crop gets harvested, which I know thinking about our customers globally, there's been a lot of sticker shock I think this last season, but with this price inversion, potentially provides some relief. Of course, that's all incumbent upon this crop being strong and coming to fruition. So we're certainly looking ahead to that. One thing that really jumped out to me, on the last table that you had pulled up, looking at all the different crops here. Yeah, Jim had mentioned in his opening comments how we've actually restored forest land over the last 30 years. We've seen that total acreage figure come down, which and 2 points I want to make on that. One, I think that's reflective of the overall sustainability and looking at sustainable intensification of production in the U.S., doing things efficiently with minimal area or not the opportunity to expand. But even looking on a shorter horizon, prices at the farm level have been very, very strong. But we're not seeing the commensurate area response that you would notionally think there. What do you think are some of the contributing factors why cropland area as a whole has been coming down, at least relative to the past couple of years when prices weren't as strong?
So we do have development, around our cities, and there's a lot of cities in the Midwest in the crop growing region. So we lose some acreage, to development a little bit. Historically, our yield gains in corn and soybeans have greatly exceeded our loss of acreage. So in soybeans, I think our 15-year yield trend is for about 0.9 bushels per year per acre, so almost 1 bushel per year per acre. And that actually means that over time, with the current land inventory that we have, we're going to keep seeing increases in total production in the U.S. as our trend increases. We think that that trend is a pure technical trend. And so it's sustainable as long as, we keep having the R&D investments in equipment and crop protection and seed. A really interesting thing about that chart is even though total acreage went down, if you look at the share of corn and soy, which in the US is almost all of it's rotated 1-to-1, that acreage has gone up over that last 20 years. So corn and soy is getting a larger and larger percentage of the total cropland in the US. So we're holding our total acreage in those key crops. And because rotating those crops is so efficient from an agronomic and an economic standpoint, we really don't see an opportunity for soy to go to 94 million acres in the US and corn to drop to 86. It's, I know the market was setting up for people thinking that way before the war in particular, maybe in the first calendar quarter of this year. But the need for feed grains grew exponentially as soon as the war happened. And so, it's really hard for soybean price by itself to drive a big change in US acreage because of how we rotate. If you survey the farmer and ask them specifically like this, if you say, at what soybean corn price ratio would you change your rotation? The answer almost is always never. So in the people who survey farmers to try to get a sense on, are bean acres going to be up, corn acres going to be up, they don't ask the question that way. And in the US, I think that's the most important way to get at that subject.
It's a fantastic point. I think back to the fall when we were starting to see, the real sharp run up in fertilizer prices as, farmers are, in the key input purchasing season in the U.S., post-harvest, making your purchase decisions and crop plans for the next year. And even as those fertilizer prices were really high, you'd think, okay, this is disincentivizing planting corn, which is, of course, is very thirsty for fertilizer. But most of the farmers that I talked to on our boards, said, look, I'm trying to stick to a 50-50 rotation as best as I can because that is what is agronomically best for my production here, which I think really underscores the value that farmers place in sustainability. I mean, sustainability, manifests itself in a couple different ways. Certainly you think about the land, but of course profitability too. And, if you're not stewarding your land appropriately, it's not going to, be as profitable long term. So, really managing that nitrogen cycle through that corn soy rotation is, pretty acute need here. So Marty, we'll come back in a few minutes, but in the interim, I want to kick it back to Jim here because we've got an exciting segment coming up.
Great. Thank you so much, Mac and Marty. That was very, very helpful and insightful. And I think we all benefit. I'm thinking about myself and all the people that are listening when we get to hear people like yourselves who study these numbers all the time. Give us your clear insights on them. We may look at a particular number, but not have as much background. So thank you so much. And please remember, as was just mentioned, put your questions in the Q&A chat. Put it in the chat if you have a question, because we're going to come back in just a few minutes and we're going to have a Q&A session. But now, please help me welcome Carlos Salinas. He leads our Americas team. He's our regional director. So he leads our team of experts down in that part of the world in collaborating and working with companies and in-country stakeholders so that USSEC and USSOY can continue to be a preferred protein choice for sustainable and reliable solutions for the animal, the aquaculture, the edible oil, and the food industry. Carlos has over 25 years of ag commodities experience, formerly serving with companies such as ADM, Bunge, and Continental Grain. So I'm looking forward to hearing what Carlos has to tell us. Carlos, the floor is yours.
Thank you, Jim. Much appreciated. Appreciate the intro. Thank you, Mac, Marty, for your inputs and presentation. Very valuable. I guess it's it's difficult to dissect what's happening and make sense out of what we see. One thing is for sure, we see an escalation of prices And obviously our customers, which many of them are on the line, are wondering what those drivers are and certainly have questions about the implications. One thing I like to share with you, and I think I have been surprised, have been the trade flows between U.S. soybean meal, soybean oil, and soybeans to Latin America. And I guess I've been surprised by the resilience of those trade flows in the context of very high prices, right? And this report, I believe, highlights how tight the situation is and highlights, the new crop estimates that we have for next year. But let me share some of those numbers with you, and maybe this is going to give us an idea of the elasticity or lack of elasticity of some of the flows that we have. So I collected some of the information from USDA export sales. In this particular case, we're looking at soybeans for the week ending on June 16th. And we're looking at soybeans here. And on this report, you look at accumulated exports, and you can see that for this particular week, we have shipped already 5.3 million metric tons of soybeans to the region compared to 5.1 million metric tons during the same time last year. And if we look around and we take a look at outstanding sales, that is commitments that are on the books that have yet to be executed, this week we have 1.3 million metric tons of open commitments against 900,000 metric tons compared to the same time last year. So they are interesting numbers. And when you're looking at soybean crush at destination, our region has also benefited from expanding crush margins. So I think it's understandable how the crushers want to have more stocks in position, how they want to buy ahead and make sure they're very well logistically positioned to execute and lock in those crush margins. While it is a bit of a surprise, it doesn't surprise me that crushers want to capitalize on these higher crush margins. But when we look around and we take a look at soybean meal, and our region is mostly a soybean meal market in its essence. Accumulated exports for the region compared to last year, we're at 5.6 million metric tons of meal exports compared to 5.4 million metric tons during the same time last year. And we have some interesting highlights. We have Colombia up 1.1 million metric tons. We have Ecuador showing some significant growth, and we also have Venezuela, again showing significant increase on the shipments. When we take a look at outstanding sales, we're also pleasantly surprised because we see commitments on the books yet to be executed of 1.8 million metric tons of soybean meal compared to 1.3 million metric tons last year. So and some of the highlights are certainly Colombia with almost 400,000 metric tons of commitments versus almost nothing last year. Honduras, Venezuela, almost 90,000 metric tons of soybean meal bought versus zero during the same time last year. Now, I believe that the industry is realizing the importance of supply chains. I believe that while there is inverses in position, people want to make sure they're logistically positioned, well planned, and they have a program to execute the supply that they need to feed their animals. It's a very good reaction to see, but it tells you that we are a very inelastic market. When we take a look at soybean oil, we see a slightly different story, and I mentioned slightly because we have exports for the week ending June 15th at 317,000 tons versus 380,000 tons during the same time last year. However, we have countries like Costa Rica, which have more than doubled their shipments, and Mexico, surprisingly, has 72,000 metric tons of oil shipped already versus 36,000 last year, a significant uptick, and we're trying to understand why. We believe it could be in part maybe palm oil plays a role in this increase of soybean oil, but it may also have something to do with used cooking oil making its way to the U.S. Behind those incentives. So we're trying to dissect that a little bit better. When you take a look at when you take a look at oil and you look at outstanding sales, the region does have about 63,000 tons bought versus 25,000 tons during the same time last year. Again, some of the countries are listed below that show some of those increases, which I found pretty telling. But I think the question is, what's happening in the region? One is one of the major pillars impacting this. And this is an economic forecast. It's a composite of many banks, which I like to share with you. I think it's important to highlight. 2020 on average for the region was very rough. The economies dropped, their GDP dropped about 6%. But as an aggregate, the region made up those losses in 2021. And the forecast for 2022 and 23, they do show growth, which is very, very good to see. We do have some countries which are some important highlights. Colombia dropped almost 7% of its GDP, and they picked that up almost 11% in 21, and they continue to show growth in 22. So we're very excited to see that. We have Mexico, one of our biggest market, with a different type of economy. Again, they dropped about 8% in 2020. They have partially picked that up in 21, and they're showing recovery in 21, 22, and 23. Peru is an interesting market where the economy dropped 11%. They made all that up and more in 2021 and are also calling for good growth in those areas. Certainly, and from economic perspective, there are winners, there are losers in this, but I think as an aggregate, the region is doing quite well, and we hope the trend continues. I think we are very healthy conditions. We don't think prices have yet had a significant impact rationing demand, so we are looking forward to what the future may have to bring, and certainly we're here to help. So I don't have anything else that I can share with you at this time. Happy to answer any questions in the future, and once again, appreciate giving me the floor for a few minutes to share some of those thoughts. Thank you.
Carlos, really, really fantastic insights, and really appreciate the spotlight on the region. Clearly, there's a lot of dynamism going on in the market, and I candidly, I hadn't really appreciated the rebound in economic growth for the region there. And I think even looking at it in even a little bit more segmented way, some of the markets that are kind of on the lower end of those rebound and growth trajectories, like Brazil, Chile, for example, those aren't larger, those aren't really markets for USSOY. I think for obvious reasons. Obviously, Brazil is cultivating its own. So the markets that are really the centers of demand are the ones that are experiencing that strong growth and rebound, which obviously great for soy, but more importantly, great for domestic consumption rebound. I think particularly as everybody's coming out of COVID. So I want to welcome Marty back on here. We've got a couple questions rolling in here. First and foremost, we've been talking commodities and really commoditized soy here, but I'd be remiss if we didn't talk about some of the attributes that we have in terms of being suppliers of choice, including non-GM soy. In the country, in the U.S., non-GM soy is it's a smaller segment, of course, but it's very important for the human use market. So in particular, the area under cultivation in North Dakota, and there's a lot of identity preserved non-GM soy grown up there. If we're seeing the decline in aggregate soy area there, what are some of the expectations for non-GM production? Marty, do you have a read on that at all?
It's going to get really complicated in the Dakotas. So I think we're going to have two distinct geographies for that: Eastern Corn Belt and the Northern Great Plains. In the Northern Great Plains, we have a lot of new crush going in. And there's less new crush being installed in the Eastern Corn Belt. So the opportunities to maintain non-GMO production in the Eastern Corn Belt, I think, are good. In the Northern Great Plains, which is generally defined as the Dakotas and northern Minnesota, the expansion of crush is really going to, I think, push people to need to grow a GMO bean so that it can go either as a whole bean to the PNW for export to Asia, or be crushed and the meal will go out. So, yeah, we don't know for sure, but that, to me, the new crush in that area is going to probably change farming practices to a degree.
So you mentioned the crush expansion here, and I think particularly in the northern Great Plains, where there haven't been as many facilities historically. We're seeing crush plant announcements really across much of the Midwest, and of course we have those plants in the northern Great Plains which are coming online. What are some of the major driving factors behind that? Why are we seeing this wave of crush expansion right now?
So the most basic way to look at this is to think about that every soybean that's grown in the world has to be crushed to be used. I think sometimes people forget that fact. For a very long time, crush expansion has occurred in South America and at destination. So at our customers all over the world, that they've been expanding crush. Because of some biofuel policy and some preferences on how to meet the demands of that policy by our oil companies in the U.S., the capital investment into new crush is going to be in the U.S. for the next 4 or 5 years. I don't have good numbers, so I want to say this with a little bit of hubris. We think that there's very little new capital going into crush in the rest of the world at this moment, while the U.S. is going through this big crush expansion. The U.S. crush expansion looks like it can be almost 800 million bushels measured from January of 2021. Through end of calendar 2025. So that number is, I think for sure we're at 650 right now. And there's some other projects that are really close to getting to the final stages, in terms of ordering their equipment, arranging finances. So that number, I think for sure will go over 700 million bushels, and approach 800. I don't know exactly where it's going to stop, but it feels to me like it's probably going to stop there. And then, after that time, crush development will go back to destination in South America.
So really interesting dynamics here, and I want to unpack a couple additional elements of that. So one, with the announced crush capacity expansion, let's call it 650 million bushels to 800 million bushels incremental, right? And I think just for a reference point for our audience, we crushed, I think, just around 2.2 billion bushels last year, maybe a shade under that. So that's 650 to 800. I mean, that's basically, roughly a 30% increase in terms of total capacity. And you'd mentioned, the California market there, which is, I think, going to be very thirsty for soybean oil domestically. So soybean oil is taking on a greater importance as a driver for crush. The offshoot of that is, presumably we're going to have more meal available, which I think is good news for international customers. Again, bring it back to Carlos and his region. We have a lot of major meal markets down there, and I think when you see those growth trajectories that Carlos laid out, that's pretty exciting. I mean, what are you seeing and expecting in terms of meal markets and demand in the coming years as we go through this tectonic shift in the U.S.?
So the first thing that'll happen is we're going to have enough meal come on fast enough that the price of U.S. meal will go down relative to what it's been. And that's also going to lower the price for distillers' grains, because the meal and distillers' grains in some feed rations are substitutes. So you won't see distillers' grains trading at a premium to corn. It'll probably trade, on par with corn. This is very good for people who want to increase value-added opportunities in the U.S. So our meat markets could expand. We don't need to consume any more meat in the U.S. We're sort of a fully developed consumption market. So that means that expansion would be available for meat exports. So we're going to be exporting meal as meal. We export beans as meal already. You know, when people ask, where does the meal go? I go, everywhere soybeans go, meal can go, because, you know, all soybeans have to get crushed. So to understand how crush or how meal demand is increasing in the world, you really need to look at whole bean trade plus meal trade combined, you know, and then take the oil out of that. And then you know what the real meal demand is in each of the destination markets. So we're going to be in an adjustment period probably for the next 6 years. And then we'll get to a new equilibrium, and this issue will shift overseas. But we're going to be a very good exporter of soybean meal to everywhere.
So if I'm taking what you said about both soybean meal and DDGs, if I'm a feed miller, whether I'm in the U.S. or a destination market, that sounds like music to my ears. You know, as far as like this adjustment period, and naturally we've got, you know, overall tight supplies globally, you know, in soy, but across all the major, you know, oilseed crops. But I think as we get through this period of adjustment, that's going to be beneficial going forward. Got another question coming in, and again, it's kind of a focus on the northern Great Plains here. So producers in the Dakotas, Minnesota, you know, going back to your comments on prevented plantings, if you know, with price levels where they are, producers are foregoing that. Is the expectation that if something is going in the ground, do you expect it to be more corn or soy or 50-50, given the rotation comments from before?
Well, there's very specific rules about prevented plant. If you take prevented plant insurance, you cannot then go and plant that crop. So you have to plant something else. So for this year, farmers need to decide to take the insurance money, you know, to recover their inputs, or take the risk and go ahead and plant it and have reduced crop insurance for the balance of the season. Prevented plant, let's take a state like Ohio. If Ohio has a prevented plant year for corn, soybeans have a faster maturity, and so sometimes we'll see some switching to soybeans. Mm-hmm. You know, when that would happen at lower latitudes. When you get to the northern Great Plains, it gets complicated because the season is short, but the growing day itself is long. You know, we have very long sunlight periods the further north you go. So it's a complex decision what to make. You know, you know, farmers want to plant something, but they're sort of limited in their opportunities, what else they can do, you know, with that ground in the northern Great Plains.
So you'd mentioned, you know, kind of shorter maturity and everything, and, you know, I used to work for an input provider, so my mind naturally goes towards input availability, right? I mean, if you're going to be planting something that needs kind of a shorter maturity window, you're kind of, if you're a farmer, you're kind of at the mercy of, you know, what's available in terms of maturity groups that can fit that. But, you know, let's widen the aperture a little bit and think about inputs as a whole. We've, of course, seen really significant prices in diesel fuel. We've seen significant prices in fertilizer, just like these input costs, which are really putting a compression on farmer margins. You know, even as farmers are trying to stick to that 50-50 rotation, the scale of these input, you know, price increases is you know, heretofore kind of, you know, unprecedented. So, are we seeing any volatility and potential acreage shift from that way? I mean, you know, either on the margins of, you know, what needs to get resurveyed, or, you know, potentially for next season too.
So even though we're in an inflationary period, there's limits. Okay, at some point, there is a nitrogen price where farmers just won't buy nitrogen, and they do for a season what we call they mine the soil. So there's always some leftover nitrogen in the ground. So this year they'll go with less nitrogen. And at some point you get enough change in behavior that it affects the prices of everything else, you know, and the prices reset. If you follow the news right now in the US, they're talking already about we're in the summer reset period for input prices. And I'm not in agronomy, so, I'm a little bit out of my depth here, but, there is a limit to the prices, and it's what, the farmers can get, and they have to manage that risk too, so as prices go higher, the need for risk management becomes, almost more important. But there's a cost to that too.
Now, naturally, literally no free lunch here, and even in a higher price environment, there's still a lot of other factors to consider. Marty, really appreciate all your insights today. Really enjoyed the discussion. I apologize to anyone who submitted a question that we didn't have a chance to get to, but we are coming close to time, so I want to give it back to our CEO, Jim Sutter, for some closing remarks.
Great. Thanks so much, Mac, Marty, and Carlos. Thanks very much for sharing your wisdom and your thoughts with us. It's been great to have you here. Let me just try and make 3 closing comments as we get ready to go. So as we all know, no harvest should be taken for granted. And it's important because we have these tight supplies and demand continues to grow, as we talked about. But one thing I want to leave you with is I believe U.S. farmers are taking extra care to be maximizing the production that they are going to grow this year. We know that U.S. soy production is important to the world, especially right now. And it looks to me like, given all the things that they're doing, now Mother Nature has a lot to do with it, but I think our farmers are working really hard to maximize their yields and make sure they grow a big crop. So my money's still thinking we may grow a record this year, even if our acres are not quite a record level, but I think our yields will be a record level. So watch that carefully. Secondly, I think world supplies, they're really tight, which is why prices are high. Our experts have talked about that. And there's a lot of risk and those kind of things. I think all that means that the reliability of our U.S. export supply chain is critical. So make sure you're working with our exporters. We've got a lot of very, very reliable exporters and export systems on literally all sides of our country. So make sure you get your logistics locked in and your supplies. But I think really reliability of that supply chain and what we can do from the United States is really critical. And finally, just as our U.S. soy farmers and our U.S. soy exporters are working hard to make sure we're delivering to the world, our team at USSEC is doing the same thing. So we're here for you. We have teams and people around the world, and we literally are there. We want to meet with you. We want to answer questions. We want to get you in touch with our exporters or others in our industry and make sure that we're there to help connect you with U.S. soy. So if you don't know who to contact, reach out to me, go to our USSEC website, just somehow get in touch with us. I'm sure you probably do know the people, but if not, make sure you come to us. So finally, I want to thank you for your time today. And thank you for the ongoing partnership that we have between yourselves around the world and our U.S. soy team. It really does take a great partnership, all the way from farm to people around the world that turn the products we grow here into food for customers around the world. Thanks for working together. Please stay safe. Please be careful. Please keep watching these markets, and we look forward to the next time we get to do this. Thanks to our speakers. Have a good night. Have a good day. Happy Friday.